Good afternoon. Thanks for joining us for Sprague Energy's Market Brief. I'm Taylor Hudson with Hugh McNaughton. This past week we had a relative sideways trading market, not too much occurring. This afternoon we're going to settle somewhere about 3 cents north of where we started the week. But this week we also had a familiar event. We had a rumor proven not true, and as some of our customers have pointed out, Hugh, it seems that the Saudi pipeline guy was at it again this week.
This time, though, without the benefit, I think, of the Iranian state media, because this went the wrong direction. This went down first rather than up.
That's right. So on the chart read here for the week, we're going to end the week up about 3 cents, and really the market remains stuck in a 10-cent range, so anywhere between 320 and 330. And of course, we're talking about 2 oil here, or distillate pricing. Major resistance will be the high that we hit on Wednesday at roughly 330, and the low that we hit yesterday, Thursday, at 320. If the market does take off next week, it'll have to penetrate the February 24th high just below 332. On the downside, if the market was to come down, we have moving average support at 325 and then some serious support at 317. Hugh, what was? Can you refresh our memories on some of what the news cycle was like early in the week when we were sideways?
Yeah, sure. For the first three days of the week, market traded again, support in that sideways fashion. Monday was a 2 cent down day after China's surprise trade deficit news. Italy starting off in a recession. Tuesday we had a 3 cent recovery. Prices are again now responding to strong German investor confidence, strong U.S. retail February retail sales, and the Fed's no surprise low interest policy maintenance going forward. Wednesday we gave up the penny, so here we are now down to exactly where we started. This time on mildly bearish EIA statistics showing a crude oil build in line with expectations. But Taylor, it was Thursday when the excitement really started, and
that's right. We decided to take this opportunity to again sort of showcase the impact that a rumor can have on our markets. So what our listeners are looking at here is a 10-minute chart of the 2 oil market. So each red or blue candlestick represents a 10-minute moment in time. It was just after 11 o'clock that the IM screen started to light up, and CNBC started to run a story about an SPR release. And in just under 10 minutes, we dropped from 325.5 all the way down to 320.5. So a 5 cent move in 10-minute time. Someone must have called the Obama administration, because about 30 minutes later, we had a second flurry of activity with the White House denying the rumor. And just to be clear, the rumor was that the U.S. and the U.K. were going to coordinate to some fashion on an SPR release that would be called for by the U.S. You can see by the end of the trading day, the market had recovered almost all of the losses, and today obviously we're trading at 328. So the impact of this thing was extremely short-lived. Hugh, I can swear that we've been here before, and I wanted to say that perhaps there was one of these releases last year?
yes, there was. If the speculation is true that recently here that the U.S. administration is planning or looking or considering another SPR release, unfortunately, it's an indication of the fact that they haven't learned the lesson that they should have from what transpired last year. The trading community that I'm in touch with largely views any SPR release, certainly under current conditions where there are no actual physical shortfalls in place, which was the same as last year, just basically a set of maybe negative economic or financial circumstances, as essentially an exercise in futility. Last year's events, as that chart there shows, we had a fairly substantial impact, immediate impact. In fact, one day, with a little bit of follow through on the next day, but within a week, within 8 days, we were back to the same, in fact, higher levels than where the SPR release occurred. Just effectively no effect is what it boils down to. If the conditions are such that there is no physical shortfall in place, then the release, especially of a relatively small amount, relative that is to the overall levels of strategic petroleum reserves in the U.S. and internationally, aren't substantial, then all that's going to happen is it's potentially going to scare off a few of the more insecure longs, speculative length, out of the market. We may have a fairly dramatic immediate impact, but it's going to, the more it occurs, the lesser time it's going to last.
So it's kind of interesting because it in a well-supplied market, basically an SPR release just means we'll make more crude available to refineries that already have plenty to choose from.
Exactly, and as in the case of last year, of the 60 million barrels that was made available, 30 million barrels of crude in the U.S., 30 million barrels primarily of products in the rest of the world, relatively little was ever just what's the word I'm looking for? Was ever actually released? Was ever even made available?
It's a good time, rumors about releases are a good time to just revisit some of the facts about the SPR. So this afternoon we pulled up some information off the government website. Currently, the U.S. SPR is holding 696 million barrels of product, and that's equivalent to roughly 80 days of import protection. And according to the agreement signed with the IEA, the U.S. is supposed to have 90 days worth of import protection on hand, which it does have when you combine the SPR stocks with industry stocks. This is a fun fact to know. If you look at the average price paid for oil in the reserve, it was only $29.76. So
Taylor, it was a wonderful taxpayer investment.
That's what you call a mark-to-market inventory gain. But on the serious side, just want to again point out what's underpinning some of this market here, and that is the boogeyman, if you will, is a war with Iran. The Strait of Hormuz being closed for an extended period of time. And when you look at those numbers, it is pretty amazing how integral the SPR would become if that event unfolded. Even if we estimate that there's a war and some cargoes get through, figuring an aircraft carrier or something like that can escort a few cargoes out of the Persian Gulf, you're still talking about somewhere in the neighborhood of 13.2 million barrels a day being disrupted, coming out of that usually flow through the strait. They could probably put about 3.2 million barrels a day through the pipeline across Saudi Arabia to the Red Sea. But we would need 8 million barrels a day to come from the global SPR stocks, and 2 million barrels a day would not be available. There would be no spare capacity, and as economists like to call it, demand destruction would take place, meaning prices would be so high that you and I would not use or consume the fuel. So this 8 million barrel a day level, that would be somewhere in the neighborhood of 3 months worth of consumption, and that varies. In some countries, there's obviously more on hand than others. So that's, I think, our point is that if that was to occur, then the release of SPR stocks by the administration would be a little more meaningful to the physical trading community.
Absolutely, and that's why, of course, any release in other circumstances other than the ones you've just gone through is so controversial. It becomes then a question of, is it being used for some fashion other than what it was designed?
So sort of a curveball here at the end of the week. Hugh, who'd you pick to win the tournament?
Well, let me see. Do you recall who the president chose? I'm not sure what bracket I was in there. What about you, Taylor?
Well, the Hokies didn't make it, so I'm not even paying attention. No, we hope everybody has a wonderful weekend, and we'll talk to you soon. Thank you.